We're going to take a brief break from our mining coverage today in the interest of covering a story that has long been a retail favorite within the small cap space. NuRan Wireless, who is focused on telecom in Africa, has long had a dedicated shareholder base that follows the company closely. And with the company recently releasing their first quarter financial results, we thought it was as good a time as any to provide a little coverage on the name. Don't miss the Rural Symposium for Natural Resource Investing happening July 7th in Boca Raton. If you can't make it in person, that's not a problem. You can get your ticket to watch live online or on demand. We'll be there with the deep dive, so if you make it out to Boca, come say hi at our booth. If you want to sign up, click on the link in the description to get your pass. Let's dive in. NuRan in the first quarter of 2025 posted top-line revenue of $2.2 million, which was an increase of 285% on a year-over-year basis, up from $573,000 in the first quarter of 2024. Aside from the simple revenue is higher analysis, the key aspect here is that roughly 75% of revenue was attributed to what NuRan refers to as Network as a Service, or NaaS. A total of $1.7 million in revenue was associated with this NaaS model, of which 90% was attributed to operations in Cameroon, and the remainder to operations in the DRC. An additional $208,000 was related to product sales, while $344,000 was related to an accounting adjustment required as sites become operational. After cost of sales of $311,000, NuRan recorded a gross profit of $1.9 million in the first quarter of 2025, as compared to a gross profit of just $46,000 in the first quarter of last year. Margins improved from 8% to 86% year over year, with the margins now said to be more in line with company projections. However, after operating expenses of $3.6 million, including $1.9 million in financing expenses, the company recorded an overall net loss of $1.7 million, or 3 cents per share for the quarter, which compares to a net loss of $2.4 million or 5 cents per share in the year-ago period. The bright side here is that NuRan has hit positive EBITDA territory, recording $450,000 in positive EBITDA in Q1. This, of course, is after backing out those financing expenses, of which $1.6 million alone is attributed to interest, which is largely related to short-term debt service costs to support a capital facility. In terms of cash flow used in operations totaled $1.7 million, as compared to $900,000 in the year-ago period. NuRan ended the first quarter with cash on hand of $1.2 million, which was basically flat versus the start of the fiscal year, while working capital declined from negative $19.1 million to negative $20 million. Operationally, things appear to be progressing steadily for NuRan, which is a positive. The downside here, however, is that they are not progressing at the rate that they have previously guided to. While no new telecom sites were launched in January, NuRan in February successfully launched 20 new sites, while also providing guidance for deployments through the first half of 2025. Total site deployments scheduled for the first half of 2025 was pegged at 204, with 20 marked for February and 42 marked for March. But in March, they managed to only successfully launch 20 sites, with the shortfall of over 50% blamed on sites being in transit. As of April 2nd, the company had deployed 40 sites all year. Despite missing guidance issued the month prior, NuRan indicated that they were on track to still deploy all 204 sites by the end of June. The delays were said to be localized to the DRC, and that it should be just a short-term issue. Which fine, delays happen, but a month after providing guidance is a bad look no matter how you cut it. NuRan, from what we can tell, hasn't provided details on any further developments since that April announcement. When we called the company up, we were told that things should be caught up by mid-June, July, with it being reiterated again that logistics has been the pain point here. Okay, it's no secret here that the primary pain point for NuRan is their balance sheet. And after sitting down with management, it is rather clear that this could, and I put an emphasis on the word could, be a great little cash-generating business. The model itself is simple. Deploy sites at a cost of about $25,000 per site, and once operational, each site generates on average about $2,500 in monthly revenue and can operate for anywhere from 10 to 20 years, provided the tech remains relevant. Simple math suggests a 10-month payback period before interest is factored in, after which most of that revenue is free and clear margin. The problem is the balance sheet, which right now doesn't really allow for the model to play out that way. The first quarter saw $1.6 million in interest charges on revenue of $2.2 million, $1.7 million of which is related to their service model, which isn't a point of strength by any stretch of the imagination. But NuRan knows this. Their working capital position alone tells the story here. And by all accounts, resolving the funding solution is their main priority while they work to get out of their current short-term debt cycle. Talks are said to be occurring related to this, with the primary focus being converting current short-term debt to long-term while also securing additional funding for further growth. 4 options are said to currently be on the table for how this could potentially move forward, with those options including the potential conversion of some debt to equity and bringing in financing at the project level rather than the corporate level. NuRan isn't quite at the point where they can make a decision by the sounds of it, but in the interim, they'll be continuing to focus on obtaining positive EBITDA so as to build confidence with lenders. All right, so let's wrap it up. NuRan had mixed results for the first quarter. While revenue improved dramatically on a year-over-year basis, the working capital position deteriorated versus the first quarter, which normally would be fine, but we're in negative territory here, so it is a concern. Long-term, this looks like it could be an interesting operation, but short-term, that requires the company to find a way to manage their balance sheet and get through to the other side. They've got plenty of opportunity in front of them. As per the MD&A, there are literally thousands of sites that can be built, but the question remains whether they can find the initial capital required to get it done. All right, everybody, thanks for watching. I'm happy that we're covering something that isn't mining for a change. I feel like this is kind of getting back to my roots in the space where I used to cover boring old micro caps that are actual operating businesses, not really in the mining space. We've been doing a lot of mining lately, which is obviously something we've gotten really strong at. But if there are those sort of, boring micro cap companies you want us to look at, as long as they're Canadian based, we're happy to give them a look. Also, guys, if you enjoyed this content, do me a favor, smash that like button, subscribe, ring that notification bell. All right, everybody, thanks for watching.